On behalf of Prabhudas Leeladhar, I welcome you all to the 2Q FY19 earnings call of Borosil Glass Works Limited. We have with us the management represented by Mr. Shrivar Kheruka, MD and CEO, and Mr. Swadhin Padia, CFO. I would now like to hand over the call to Mr. Kheruka for opening remarks, after which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you. Thank you for that. So, greetings and welcome, everybody. Glad to be talking to the investing community again, along with the CFO, Swadhin Padia. Borosil's board met yesterday and approved the financial results for the quarter and half-year ended September 2018. Our results and an updated presentation have been sent to the stock exchanges and have also been uploaded on the company's website. I can therefore briefly run you through the highlights of our performance and then open it to the questions that we'd be glad to address as best we can. As you're aware that during Q1 and Q2 of last year, there was a discontinuity in terms of implementation of GST. This led to lower sales during June and July 2017 with a pickup from August 2017 onwards. It would thus be best to compare sales for the first half of the year as a whole rather than for each quarter. Having said that, we still do not have strictly comparable periods as Diwali last year happened earlier and some of Diwali sales which happened in Q2 will actually happen in Q3. So in some sense, our growth levels are a bit understated as compared to the year before. In spite of that, our overall revenue during the first half was 251 crores, which represents a growth of 23.1% over H1 FY18. The consumer products division achieved a revenue of 161 crores, a growth of 23.5% over the first half of the previous year. Again, I must specify that this also includes the provision of Ind AS 115, and if we remove that provision, the growth was north of 30% for the first half of the year in the consumer division. Products under the flagship Borosil brand grew by 23%. The company is seeing a very encouraging response to its new product launches. As I've been mentioning for some time, we've identified glass storage in the kitchen and on-the-go products as a segment with strong potential. There's a definite tailwind supporting a shift from plastic storage to use of glass. Borosil is facilitating that shift with high-quality products designed for both aesthetics and functionality. For example, easier stacking in kitchen cabinets to optimize space or vacuum sealing closures to retain freshness. In addition, consumers are also looking for high-quality steel products as glass is not always suitable for on-the-go usage. Anecdotally, I hear of more and more office goers carrying Borosil glass lunch boxes to work. Similarly, the Hydra range of flasks and steel lunch boxes is also doing very well. Last quarter, I had mentioned that Borosil is now the hydration partner to the Indian Olympic Association until 2024. We made a very good start, in fact, to our Thirst for Gold campaign with a heartwarming video of a young fan encouraging one of India's wrestling champions, Bajrang Punia. And it was fortunate that Bajrang Punia won the first gold in the games, in the Asian Games that just went by. Bajrang Punia went on to win this gold, and the video became quite popular over social media. Lara had become a 100 crore brand last year. During the first half of the year, Lara recorded sales of 71 crores, which is a growth of 24% over the first half of last year. Again, I mentioned that owing to Diwali being a bit later this year than last year, we expect the sales growth to accelerate. You may recall that in the second half of last year, the company had undertaken a capacity expansion and plant upgradation at its Jaipur manufacturing facility. The production output is now streamlined. The product quality is very consistent with higher mechanical strength. In fact, some of you may have seen a recent television commercial about the young couple shifting homes when the husband labels the box with Lara Dinnerware as books by mistake. And despite rough handling, assuming that it contains books, the plates remain fully intact as Lara Kafi strong hai. We have improved our design capability as well. We've introduced a new product range called the Moon series, and that's specially suited for the Indian way of eating with lots of different sabzis and, where you can put up to 3 katoris in the plate and still have enough space for chapati and as well as chutneys. This has been received very well in the market, and we've placed it at a premium of almost 15 to 20% over the normal Lara series. revenue in Borosil's SIP division was 89.4 crores, a growth of 22.4% over H1 FY18. Here I must mention that Ind AS, these numbers are a bit overstated owing to Ind AS because the actual growth was about 13-odd%. The labware division with sales of INR 69 crores recorded a growth, as I mentioned, of 23.1%. That's with Ind AS 115. However, we are quite happy with the growth in this division. The instrumentation business under LabQuest is receiving an encouraging response. As we're targeting import substitution, the company commenced its operations at its product design, development, and assembly in Pune, a wholly owned subsidiary called Borosil Technologies, and we expect to add to the LabQuest range. Glasspack achieved a revenue of INR 21 crores or 20.7 crores, a growth of more than 20% over last year. Our acquisition thesis is playing out. Borosil has been able to use its existing customer relationships in the pharma industry to add to Glasspack's portfolio of customers. In fact, we've added a couple of tier A customers in this area in the last year, in the last 6 months. We are a clear number 2 player in this industry and expect to continue to grow the business at a healthy clip. Coming to EBITDA margins, EBITDA from operations grew by 11% at 37.2 crores over last year. The growth in EBITDA margin lacks top-line growth. And this is for the main reason that we have spent a little bit more money on advertising and sales promotion expenses, almost 7 crores more compared to the first half of last year. If you keep the same A&SP spend as last year, our operating margin would have been similar to last year. However, we are taking the view that we must look for long-term growth, and we will sacrifice short-term margins to this effect. Having said that, the one area where we have had a lower EBITDA margin is Glasspack, despite a strong top-line growth. The main reason is, as I mentioned, we've added a couple of new customers, more demanding customers in the last 6 months. Their product range is a bit more challenging to produce, and we have been stabilizing that range. However, in the interim, we have had to deal with some more material losses, giving a reduction in the EBITDA. I expect that going forward, this will normalize back to a level in the mid-teens in the next 3 to 6 months. As I mentioned earlier, gross margins in the business are by and large stable. The current focus is on growth. As we move ahead, we'll also manage our portfolio for a more profitable product mix. Variations in cost of inputs are not a significant risk for us. Our largest raw material, sand, is the most abundant raw material on earth. Power forms a significant proportion of our cost of goods sold. Although our manufacturing locations have slightly more expensive power costs than both domestic and overseas competitors, we do not expect any escalation in electricity prices. The recent depreciation of the Indian rupee has increased the cost of import, and that does have an impact on our overall cost structure. However, this impact is marginal, and we have been able to pass on such cost inflation through very moderate price increases. The company is reaping the benefits of operating leverage. With scale, we expect to continue to bring down logistic costs over the next 2 years. Moreover, other fixed expenses are expected to increase slower than our top-line growth. We registered a PAT of approximately 26.5 crores in the first half of the year. In just a couple of points on other developments, we have increased our shareholding in Glasspack from 60.3 to 70.2%. This was by way of a primary infusion of funds into the company in order to upgrade the manufacturing facility in Nashik. The process of restructuring is in progress. The details we are awaiting SEBI approval at this stage. We anticipate to get this very, very shortly. We expect the process to be completed by the first quarter of FY20. As far as the medium-term outlook is concerned, the company has gathered sales momentum, and the teams are focusing their energies to accelerate volume growth. There's clear expansion in the market in kitchenware and servingware, and within which there's a shift towards glass. We estimate that the current market is 50% organized and 50% organized in general, although in Opal, the organized segment is higher. However, in the other markets, it provides an opportunity to upgrade customers to better quality branded products. We see the opportunity as going beyond Opal and glass. It's a kitchen and on-the-go story with a current focus on storage and serving. Borosil consumer product business sees a runway of growth over the next few years in these two segments, which can result in fairly high growth in both volumes and value for the company. While margins are important and some of it will follow automatically with scale, we will currently prioritize volume growth over margins. Penetration in our categories is still low and there's an opportunity to expand the market. It is our belief that in consumer products, it is important to first achieve momentum and market penetration and then focus on containing costs to gain economies of scale. Of course, it will not be growth at all costs. We will be profitable. However, the profitability is not our core focus. The growth will eventually has to be sustainable and has to be sustainable for our channel partners as well. We will continue to invest in brand building so as to create a strong customer pull for our brands. As I mentioned, we have run advertising campaigns for Borosil storage range and for Lara. Apart from mass media, we are also allocating a budget to social media. We are active on Facebook, and in addition to the tie-up with the Indian Olympic Association, we have also become associate sponsors to the Haryana Steelers in the Pro Kabaddi League. Currently, our advertising to sales spend for the consumer product business is double digits, which for now is higher than the industry average. We are working on strengthening our sales channels. Currently, the Borosil network comprises over 12,000 retail outlets. Our aim is to add another 800 to 1,000 each year for the next couple of years. I think we are well on our way to do that. We are listed across most major large format store chains, and our focus is to increase depth by adding new products and SKUs in each of our distribution outlets. Borosil's new product development team plans to introduce several new dozen SKUs each year. Simultaneously, we will also rationalize SKUs from the long tail. The e-commerce channel is still small, but we're seeing increased traction. It is helping the company improve penetration beyond top 50 cities. So we now have a dedicated e-commerce team, and we expect that the contribution to sales from e-commerce could go up to more than 10% this year itself, and over the next year or two, it could go up as high as 15 to 20%. In the scientific products business, while lab glassware shows steady growth, the new avenues of exports, LabQuest instruments, and ClassPack will improve the growth trajectory. Our blended revenue CAGR is expected to move up to the high teens, and in fact, in the second half of the year, probably move up beyond 20% as well, owing to, like I said, a later Diwali this year. EBITDA margins will expand as the company gets scale benefits, and we expect to improve EBITDA margins to between 15 and 20% over the next couple of years. Overall, I think we've had a good half of the year. We are in a very exciting phase of growth. Anecdotally, I hear good feedback. Even on Amazon, I'm seeing good feedback on our products. And I expect that the new products that we are developing will add more traction, in the coming months and years. And I'm really, truly excited about the prospects of the company, and I look forward to the future with a lot of confidence. I'm now happy to take any questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prakash Kapadia from Anivet Portfolio Management. Please go ahead.
Yeah, thanks for taking my question. I had, 2 or 3 questions. If you could share some of your thoughts, given the recent rupee depreciation coupled with, anti-dumping duty, which is already in place, isn't it time to step up the ante against, melamine, unorganized guys, and target higher growth for the opalware segment? Does it make sense, not make sense? Are we doing that, not doing that?
Hello? Sorry.
Hello.
As far as opalware is concerned, you will see a very strong growth in the second half of the year. I mean, already 20+% is not bad, but if you stick the next half of the year, also you'll see a very strong growth trajectory. We are already doing what you just mentioned in terms of targeting, the other products in this field by ad, by saying Kafi Strong Hai, Lara Kafi Strong Hai. And this will help grow the business. And we're seeing that like I said, Diwali this year is in November compared to mid-October last year. And so really the Diwali sales have not even been baked into our growth numbers. So I expect that we will have a pretty good trajectory in Opal this year itself.
Okay. And, you mentioned about Diwali being, deferred. Does our product have such a lead time? Because I would guess, towards the end of quarter or say later towards, the month, you would have seen some stocking because of Diwali, or the lead time is short, so it happens in a shorter period. That is why you see the differential in sales, if any, for Diwali.
No, I mean, our products, it depends on the format of the distribution. Trade does not stock more than a month in advance for Diwali. Trade stocks very much at the last minute, meaning 2 to 3 weeks before Diwali. So a lot of the trade sales happen just before. As far as large format stores are concerned, yes, they tend to stock a bit more in advance, but still at the same time, they place the orders in advance. They expect deliveries also over the course of time closer to Diwali. So because really a lot of buying happens straight after Shraddh, when Navratri starts. So for this reason, yes, we may receive the orders in advance, but end of day
fulfillment and
and it's ordered only obviously when we fulfill it. So yeah.
Understood. And lastly, on the opalware sales, are we planning to grow the market by, say, sub-segmenting the market? Or what I mean by sub-segmenting is, selling, say, a smaller version of a small plate and a spoon, or a dinner plate and a bowl for, say, 500, vis-a-vis, selling maybe an entire set at 2,000 rupees. Does it make sense specifically in tier 2, tier 3 markets? Is that a plan, or the focus is on the entire?
No. So in fact, if you see the trend in the market, especially closer to Diwali, is more gift sets. Exactly what you just mentioned. So 600, 500 to 1,000 rupee MRP products, which are sold in thousands, maybe even lakhs of pieces. So that's already happening. I mean, this is not something new. It's already been happening for a few years now. But so that's one segment. We also, like I mentioned, have introduced the Moon series, which is a slightly more premium segment of the market that we're trying to address. So I would say that we are trying to sub-segment the market, and that could be one of the key drivers of growth going forward.
Okay. What you meant was, you're already doing some of that sub-segmenting is what you meant when we are saying, say, Diwali could be a specific entire gift set or entire set market, but the sub-segmenting is already a part of our growth plan, and that is already happening?
Yes, it is. It is, absolutely.
Okay. And any number of the sub-segment you could share of our sales? Is it like 5%, 10% more?
No, I can't share that. Sorry.
Understood. Thank you and all the best. I'll come back if I have more questions.
Yes.
Thank you. The next question is from the line of Ashwini Agarwal from Ashmore. Please go ahead.
Hi, Shivir. Great presentation. Couple of big questions. One is you spoke about online becoming more and more important channel for you. What we've seen in a couple of other areas like garments and other fast-moving products is that there are two risks associated with online. One is discounting done by the online vendor on the overall bill or whatever it is to attract the consumer, which creates a dissonance because the prices available online are much lower than what your retailers are offering. And two is, this constant sort of discounting season, which continues in the online space where you're forced to offer discounts just to stay relevant. I mean, how important is this? Do you worry about the fact that as online grows bigger and bigger, number one, it will create a dissonance between your offline and online sales and channel partners, and number two, whether it will be dilutive for margins? How do you address that?
Yeah. So your first point is absolutely valid, and it's happening with every brand. So certainly we do find that online guys are offering discounts, and that the trade guys get irritated with those discounted offers. So what we do is we maintain a very strict watch. We have a team which is dedicated to just looking at what are the discounts being offered on our products online, and we make sure that our agreements are such that the online guys are not supposed to offer a discount over X percentage. In fact, there was a live example that happened a few days ago where one of our products was being offered at a much higher discount on Amazon. We immediately got that shut down. We made the distributor stop the offer straight within a few hours of that offer going up. So we have to be very vigilant. But we don't allow our distributors who are selling online to sell below a certain price. Otherwise, we discontinue them straight away. So that's one way to kind of handle that, that dissonance which happens. It's not always perfect, but I would say we've done a pretty good job of it. And except for one or two cases, we've not really seen too much discounting over and above what you could get regularly at a retail store. So I think we've been pretty good there. The second thing is the longer question on how does online impact margins. Yes, it will impact margins because online has become perceived as a discounting space and people go just to get lower prices. Here, what we've tried to do is do some product differentiation, meaning we have some SKUs which we only sell online, and that's not available at all in the trade. So that's one way to kind of combat that, and we already started that. Our NPD team has quite a few SKUs which they have only given online. And for the regular, let's say, fast-moving products which are available with, in both places and all channels, there we just make sure we prevent our distributors from discounting it beyond a certain level. So that's really the answer I have. I think we are still kind of evolving, so we'll have to learn more and, develop more as we go forward. But so far, we've not had any issues where trade has said, I'm not placing orders on you because you're selling this online cheaper.
Okay. Second thing is, again, anecdotal feedback coming through from a lot of white goods distributors, auto companies, and various other people that this Diwali season is turning out to be very weak compared to the last 4 or 5 Diwalis. What's your sense? How are you seeing things?
Very frankly, although I would not like to forecast what happens in Q3, what I would say is that anecdotally, yes, I've heard that. But in our space, I don't think that's really been the case. I think the movement so far has been strong, and we don't see a weak Diwali at all. In fact, quite the opposite.
Okay. And on the margins, I was trying to compute them. I, didn't realize you had a presentation up there, so I just had the results released. So there I saw a significant dip in EBITDA, and that's, I suppose, purely on account of the 7 crores ad spend and marketing spend that you had in the first half of this year. Adjusted for that, you're saying that the EBITDA is stable?
Yes, it's stable. I would also add one more thing. Like I said, the operating leverage will come in, as the Diwali quarter picks up. You'll see probably EBITDA margins improve in the next quarter and going forward. But so ad and sales promotion is one of the reasons for EBITDA to have reduced as a percentage. But the other thing is we've also been looking for, inorganic growth opportunities, and so, certain amount of investment banking fees and other related legal expenses have gone up a little bit more than budgeted. So that's also added to some extent a dip in the EBITDA percentage. However, that is a one-time kind of expense, will probably go away. The ANSP is here to stay at least for a year or two more.
Okay. There's 2 short questions. By when do you think the whole amalgamation process be over? Will it take another year or so, or less than that?
That's a really good question. I don't have an answer for you. We are hoping that by, say, the first quarter of 1920, it should happen. That's our ardent desire. We are following up very regularly with all the authorities. Like I mentioned earlier, it's stuck with SEBI. It's not stuck. It's with SEBI right now. We are hoping for approvals very shortly from SEBI, after which it goes to NCLT. As we all know, NCLT has its own list of cases which tend to be, more in the limelight, that's bankruptcy cases and so on. So they take their own time as well. They're doing the best they can, but, with the limited resources that are available. But we are following up as best as we can, and I do hope that the first quarter of 1920, that's April to June next year, it should be through.
Okay. And last question, sorry I've taken too much of time, but can somebody, Sudhin, give me a breakup of the other income of 10 crores roughly in the latest quarter or for the first half, whatever you like?
So this is the ICD, interest on ICD and income from whatever investment we have on that. That's the major fact.
And there is no exposure to ILFS or any other entity which is at risk or anything like that?
No, not at all. In fact, a year ago we had moved all our money from equity and debt mainly to liquid funds, and we've chosen the good liquid funds. So I think we're okay more or less over there.
Okay, good. Thanks. Thank you so much. Great and all the best. Thank you.
Thanks.
Thank you. The next question is from the line of Akhil Parekh from Elara Capital. Please go ahead.
Hi, Shiva. Thanks for taking my question. I have questions on Lara. Would you be able to highlight how much is the capacity currently we have for Lara and what is the utilization rate we are running at?
In rupee terms, look at in tonnage terms, we have a furnace capacity of roughly 35 to 40 tons per day, depending on product mix. Okay, and in rupee terms, I would say if we are utilizing our full capacity, we should do a turnover of 180 crores. And currently, like you see in the first half of the year, the revenue from Lara is roughly 70 odd crores. So it should just double that. That's 140. But it should be slightly more than that because, like I said, Diwali is slightly later. So we would be somewhere around 80% capacity utilization at the moment. And I would hope that, with advertising and other stuff, we can further improve upon that.
Okay. And are we looking to expand the capacity?
I would say we have already expanded capacity last year. And at this present moment, we are not looking to add a new furnace, if that's your question. But there are other ways also of adding capacity without really having to add furnaces, which we are exploring, which can marginally, expand capacity by, say, 10 to 20%. We're exploring those opportunities at the moment. So in the next 6 to 12 months, I don't think we're going to be adding a new furnace. But after that, probably it would be needed.
So in terms of reach for Lara, like for Borosil overall, we have 12,000 retail touch points. So how much would be for Lara?
It would be somewhere in the 6,000 to 7,000 range.
6,000 to 7,000. Okay, and how many distributors we have for this?
More than 130, if I remember right.
And these are exclusive distributors, right?
They're exclusive, yes, right.
Okay. And would you be able to share what kind of distributor margins that we have compared to our competitors? Is there any difference?
It varies substantially from product to product also, and season-wise, and there's lots of... So it's hard to give you a number, and I prefer not to give that to you in any case. But I'm just saying that that number keeps varying. It's not like in the case of our glassware where we have very standard terms.
Okay. In terms of the margins, right, as compared to our competitors, the leader in this segment there's a huge difference in the margins, what they have and what we are having. So two reasons you mentioned, one is A&P spend, and second is the investment banking fees, and I'm assuming at 100% utilization level we might improve our margins. Apart from that, are there any major reasons why the margin profile of our competitor versus Lara is different?
Well, see, now, if you see our margins have been growing, now we are roughly 20% EBITDA margins plus in Hopel, okay? And if you look historically, the margins were in the low double digits. Sometimes it was dipping even in single digits. So now we see a sustainable improvement in the margins. And again, as sales picks up, this margin will further increase. Outside of the two reasons you already mentioned, there's no real overall reason why our margins should be lower, save and except our competitors have slightly lower electricity costs than us in terms of per unit cost. That's due to location. So to that extent, we may have a slightly lower margin. But now, in terms of production efficiencies, we have really moved right up there. It did not happen from April. The production efficiency started moving up from April, but only in August, September. Actually, in September, October, we have stabilized at very good yields, and you will see the benefit of that in the coming quarters. So our margin is likely to move up from here, and come closer to that of our competitors. Of course, Laopala also commands a slight premium compared to Lara. So there also the average selling prices are slightly higher. But once we are able to give the product mix as we desire, I think that will also go away. So I expect the margin profile to kind of start coming closer together.
Okay, and you mentioned the electricity cost. So how much is the difference? Like for Laopala, I think it's around 13 to 14% power cost is there as a percentage of sales. How much higher we are at?
I think in terms of per unit pricing, our per unit pricing is about 20% higher. So roughly that would be the difference.
Okay. And one last question on the e-commerce side. So while speaking with your competitors' management, and so one of the points they have mentioned is many of the e-commerce channel mislabel the MRP prices in some of the cases, and it is difficult to kind of take action against them. They have tried it and they have not been able to successful in past. So would you be able to shed some light on it? Is it true or how?
Very frankly, that's the first I've heard of it. It may be the case, and they may be right, but I can check with my team. But I have not heard of this particular problem before.
Okay. All right. Thank you so much and best.
Thank you.
Thank you. The next question is from the line of Nikhil Oswal from Stallion Asset. Please go ahead.
Hello.
Yes.
Hello. No, my questions are answered. It was regarding the margins, they are answered. Okay.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Rakesh Jain from Asit C. Mehta. Please go ahead.
Hello, sir. My question is regarding the class pack. So this quarter, what we see is that you did an EBITDA margin of nearby 25%, which is same as the last quarter, and at a growth of 12% on top line. So, and right now we are at 80% utilization. So if we put it at we grow to 100% utilization and having a normalized marketing expenses, not unlike this year what we are spending more. Do you see this moving up towards your competitors' level?
I assume your question is on Hopewell and not Classpack because I think
sorry, Hopewell. It's my bad. Sorry.
Yeah. Okay, so yes, as we move our operating capacity utilization up closer to the 90%, 100% levels, certainly our margins will go up, and they should get closer to the competitors' level. Now, the competitor has absolutely no advertising and sales promotion. At least that's my understanding. Very, very low. At least last year. This year there may be more. So their margins, the EBITDA margins are closer to 35 to 40%. I don't think we'll ever hit that level. But yes, we expect long-term sustainable advertising and sales promotion to be anywhere from 6 to 8% of revenues. So today they may be 12, 13% of revenues. So 4-5% of EBITDA should come right from there. Plus, if you add on top of that operating leverage, then we can see much further improvement in EBITDA margins in the long run. The one caveat I would like to add is that people are adding capacity here. So while so far we've not seen any impact on selling prices, if people add too much capacity, then selling prices may fall and reduce everybody's margin. So that's always possible in the future. At the moment, we're not seeing any signs of it, but can't be, that's true for any industry. So, I don't think 40% EBITDA margins are sustainable forever in any industry. So, yeah.
So, whatever was your ad spends, I think, so assume the last call you mentioned about 14-15% of your sales would you do. So, out of that, how much have we already done and how much is still pending?
I think, through September, I don't know the exact numbers very frankly, but through October obviously would be a higher percentage of ad spends. But the way we do it is we take the whole year's ad spend and divide it by 12, and we expense it out every month.
So how is it distributed between Lara per se and the Borosil standalone consumer business?
That I wouldn't like to share.
All right. And could you throw some light on the SIP division performance? Actually, I joined the call a little late. So it has been impacted quite significantly. As we are registering single-digit growth, and there's a drastical dip in the EBIT margins from 21% to we are down to 16%. So what has really happened?
I'm not sure where you got that from, but the SIP division has grown. As per Ind AS, it has grown 23%. But without Ind AS, which is the right way to look at it, without Ind AS, the growth is 14%, which is, I would say, a very good growth rate for the scientific products business. And as far as margins are concerned, I'm not sure where you got that number from.
I look at the quarterly press release which was given, actually.
Are you talking about the PowerPoint presentation?
No. The quarterly press release result.
I would go more by the PowerPoint presentations, and there's no material impact on SIP margins at all, except to say that, as I mentioned to someone earlier, our legal expenses and, like banking expenses for looking for inorganic, growth has gone up, and for this reason, each division bears some percentage of that cost. So that may have some small impact on margins. But there is nothing, there's no macroeconomic issue at play currently in the SIP group.
So I believe that we even export in the SIP division, and due to the currency impact, have we seen any kind of improvement in realization on that front?
Yeah, absolutely. Exports have improved in terms of realization, but unfortunately our exports are a very small percentage of the overall business. So we import more than we export. So therefore, there has been some impact on the rupee depreciation has had a negative impact on margins. Like I mentioned earlier, it's not a meaningful impact because we've been able to pass on some of the pricing. But overall, we would like our export division to increase further, which is one of our strategies for lab.
Just slightly coming back to the CPT division, when the festive season is coming now, and the whole online sale is going there, what do you expect? Do you plan to do any sort of discounting or go into this mega sales?
So, no, everybody does discounting, but the question is the aggression of discounting. So the discounting is not very aggressive in our case. We have very limited. Sometimes we have one or two products where there are larger discounts offered. But overall, across the range, you will not see any mega discounts that we give. And we are not trying to boost our revenues just by that purpose.
Okay. And could you just explain that on your half-year balance sheet, you have some, borrowing popped up over there. What would be that regarding? And your long-term borrowings?
That's just short-term borrowing for working capital.
So the figure is quite big in number, I think, so it's about 68 crores.
Yeah, that's right. Out of that, I think majority of it is because of Diwali, we've had to increase our stocking substantially. So rather than sell any investments, we figured it's better to borrow short-term working capital.
So are you planning to do it further for the second half as well?
No, the second half will reduce substantially once the Diwali sales through and we recover the money. I think by the end of the year, this number should reduce substantially.
Oh, okay. Thank you so much. That's all from me.
Thanks.
Thank you. The next question is from the line of Naveen Bothra, an individual investor. Please go ahead.
Good afternoon, sir.
Good afternoon.
Congratulations for the steady set of numbers and good growth in the consumer business, Lara and all this. My couple of questions have already been answered regarding Lara, and I already mentioned that around 7 crores more advertisement is there. If you can throw more light about the Borosil Technologies Pune project and the collaboration with the Fox Life Sciences.
Yeah, sure. So Borosil Technologies has been set up just 2 months ago. By June, I think it was July, it was functioning. So we have in fact started receiving our first orders, and we'll be dispatching. We've hired about 15 or 17 people already, and all engineers, and we expect to start dispatching from this month of November from our own production. So that's quite exciting for all of us. The traction is good. The sales team is quite motivated. It's a small beginning, but I think it's a very sustainable beginning. And I think over the next, I can't even say in the next 3 to 6 months, but over probably in the next year to two, we should see some, positive results from Borosil Technologies. As far as Fox is concerned, our exports to the U.S. have picked up, and we've got good orders, good traction. Again, the thing is with the scientific product business, you don't get a single order which suddenly changes your numbers. It's slow and steady. You have to you start small, you keep delivering, and over a period of time, you build the business. So it takes time. It takes, and it's a patience game.
And as regarding the Lara, the small question is there about the market share, if you can quantify in the opalware segment, how much market share we are having?
Last year, we did 100 crores, roughly. And I think La Opala may have done 250 odd crores, if I'm not mistaken. So now some of their sales also come from crystal, but let's assume that that's their opal sale. And then you have Cello. I don't know their numbers. They also have in this business. I would say if you add all of this plus add imports and everything, if the market is 500 crores, then our market share is 20%, roughly. And I would say that we would definitely keep, if not increase, our market share this year.
So if the market, if you are talking the last year's numbers, I think we have increased our market share in this half year.
We should have, hopefully. But I don't know the numbers of our competitors yet, so it's hard to say. La Opala is not declared.
La Opala is also entering the glass space also, because we have already entered in their segment opalware. They are entering in our glassware also.
They have entered glassware many years ago. They are in glass space for the last 2-3 years.
Yes, sir. And the one more question is regarding the cash and cash equivalents. If you can tell us by calculating the investment of Gujarat Borosil, excluding the Gujarat Borosil investments.
Okay, Swadhin will take that on.
Yeah. So cash and cash equivalent in Gujarat Borosil we get 125.
Yes.
Yeah. So we can reduce that much amount.
No, 125 plus around, I think, 90 to 92 crores of preferential shares and all these things.
So overall, you are talking about the 125 plus 90, we have the preference shares. That's the only two investment we have in Gujarat Borosil.
So approx around 130, 140 crores we are having cash, including the investments in financial assets and all these things.
Yes. So last time it was at 265. We will remove the 125. So that's a nearby 140 is the cash.
140 crores is the cash. Okay. And my last question is regarding to Mr. Sriwood Thelka. Inorganic acquisition, if you can give more light, in which field we are looking from the investment banking proposals, in the glassware or other consumer wear?
We are open to acquisitions in both areas, scientific and consumer. So we are looking in both areas, and these things you have to explore a lot of opportunities before you can finalize any. But we have only two areas: scientific products and consumer products. So anything we do will be in one of these two spaces.
Okay, sir. Thank you. Thank you very much. All the best.
Thank you.
Thank you. The next question is from the line of Naitik Modi from OHM Portfolio. Please go ahead.
Yeah, hi Shrivar. My question is specifically for the SIP business segment, whereby looking at the market size of the international lab glass, which is a reasonably large size market compared to our other product categories. So what is the growth strategy there? That's number one. And number two, how many users, is it a very large fragmented user consumer base which is basically consuming this 4,000 crore worth of lab glass? So if you could throw some light.
Yeah, that's right. It's a very large and fragmented base spread all across the world. The thing is that there, as I've explained in the past, there are certain moats around our business. And the moats around our business in India are the fact that we have a very large product range. We have, well-defined distribution channel, and we have very strong customer relationships, which means that when a customer, since it's a C-class item for a pharma company, they don't really order, they don't forecast it. When they order it, they want it overnight. They want immediate delivery. So over the years, we have built up a very strong channel and warehousing, supply chain capability to give that product overnight. Obviously, the quality is a given. So that's the reason why competitors find it tough to enter the market here. But for exactly the same reason, it's challenging for us to enter the markets overseas, because the overseas competitors have done the exact same thing. Because this is not a new category. It's a very well-established category.
Right.
So for that reason, we have you cannot gain market share very quickly. You have to grind it out. So we've employed a few people who, we have a sales team of, I think, 5 or 6 people who are going to these export geographies very routinely, appointing distributors and dealers there, going to the end customers, specifying our product, and increasing sales that way. So in the first half of the year, we are up roughly 20%. Obviously, the base is very, very low, so it's the percentage doesn't really matter that much. But it's going to be a long journey. It's not going to give us any explosive growth as in a consumer business where you can buy a new product category or introduce a new product category and immediately introduce it to so many thousand retailers. It's not the same in SIP. Although the rewards in SIP are, once you have established a business, then it's very sticky and it's challenging for anybody to distribute.
Right, but internally, is there a target in terms of acquisition of a certain number of clients on an annual basis?
So right now we have a target absolutely for acquisition of a certain number of distributors on an annual basis in different countries, and that's the starting point. So we've already got distribution in more than 30 countries, and we would like to increase that going forward to about 50-55 countries. So we are on the lookout for those distributors, and once you have a distributor, then you start working to do the end customer coverage. That's
right. Okay, fine. Thank you, Srivar.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. As there are no further questions, I now hand the conference over to the management for their closing comments.
Okay, so thank you. So thanks everyone for all your questions. Like I said, I'm very, very excited about the prospects of the company. The first half of the year has been good. I expect the second half to be even better. I anticipate our product launches to gain better traction in the market, and I anticipate that operating leverage will kick in, across all our, consumer products. I also am excited about the prospects of, the brand building that we are doing. We have associated with sports in a big way, and I expect that to have long-term dividends as we are a young and growing country. So we want to establish our brand with that segment, say between 20 to 30 years old, who can then be long-term users of our product category. So overall, I'm quite bullish on the prospects of the company. I thank all of you for your support, and I look forward to talking to you after Q3.